introduction to accounting, preparation of books of accounting, financial statements, preparation of final accounts of companies, cash flow statement. So what is accounting? You see, accounting has been defined in various ways. According to one commonly accepted definition, accounting is the art of recording, you see, classifying, summarizing in a significant manner and in terms of money, transactions and events which are in part at least of financial character and interpreting the results thereof. Let us take an example of a bank branch. You see, in a bank branch, when you see deposit cash in your account, you see, then the balance in your account will go up. You see, your suppose you are having a savings bank account, and the balance will go up, and bank will receive cash. So cash account will be debited to your saving bank account. So cash is the asset in the balance sheet. On the asset side, right hand side, bank branch cash will increase, and on the left hand side, you see your saving bank account, that is the liability. Balance in your saving bank account will increase. Another less restrictive definition interprets accounting as the process of identifying, measuring, and communicating economic information to permit, you see, informed judgments and decisions by the users of information. Now, this bank branch, you see, balance sheet, they will know how much, you see, deposits are there, how much loans are there. On the right hand side, assets for bank branch, assets are, you see, loans, demand loans, term loans, and liabilities for the bank branch are deposits, demand deposit, that is saving bank account, current account, and term liability is term deposits. Now, demand deposits, you see, at any point of time, if a customer comes and he wants to withdraw, so bank branch has to give him immediately money, you see, either from his savings bank account, or if he's having a current account, from his current account, he will, you see, bank will give the money. So it is a liability of the bank and demand liability. At any time, you see, customer can come and withdraw money. Similarly, there are demand loans, you see, term loans. Demand loans are normally repayable in 36 months, less than 36 months or 36 months. Term loans are repayable in, you see, more than 36 months. Then cash credit, you see, is there. Then overdraft is there. So these are all the assets for the bank. By seeing the balance sheet, you see, just if we'll compare yesterday, you see, we had so much deposits, so many advances. Today, our deposits have reduced. Then bank branch will, you see the reason why, who has withdrawn the money. If any customer is, you see, unhappy with the branch, he is taking away money to some other bank. Or you see, if advances are reduced, any customer has, you see, made the prepayment, you see, he was supposed to pay the loan in EMIs, has he closed down the loan? Like that, you see, we come to know by seeing the balance sheet. Now we come on the next. Objectives of accounting are to maintain a systematic record of business transactions, to ascertain profit and loss, to determine the financial, you see, position, to provide information to various users, to assist the management, to maintain systematic record of business transactions. So again, that same example, bank branch, you see, whether deposits are declining or loans are declining or deposits are, you see, increasing, like that we'll come to know. And we are making a systematic record of all the transactions. You see, people, those depositors who are depositing money in their accounts, cash account is debited and their accounts are, you see, credited. So we are passing a journal entry like this: cash account debited to Mr. A's saving bank account. Similarly, we have, you see, granted loan to some customer. So loan account debited to, suppose we transfer this loan amount to his saving bank account. Loan account debited to Mr. A's, you see, saving bank account. So we, from journal, you see, ledger is prepared. From ledger, you see, we prepare the balance sheet, profit and loss account. In profit and loss account, you see net profit is again transferred to the balance sheet. Similarly, in business, you see businessmen, they prepare the trading account, then they prepare the profit and loss account, then they prepare the balance sheet. Whatever is the profit that goes to the capital of the businessman. Suppose it is a proprietorship concern, so it will go to the proprietor's capital if there is profit in the business. If there is loss, then again loss will also, you see, his capital will reduce. Then to determine the financial position, how is the financial position when we prepare balance sheet and other statements, we come to know about the final position of the financial position of the business. Then various users are there. You see, we can provide them, you see, information to various users. We can give them the balance sheet, and we can give other statements. And you see, if they'll feel like making an investment in the company, they will invest. If they will not feel like making investment, they will not, you see, invest. So they need the you see users, many users they need. For example, a Reliance, suppose Reliance company is there, you see, everybody will like to buy the shares because they know it will give them some profit. And now to assist the management, so top management, you see, by financial results, you see, they come to know about how they are, you see, progressing, where they are lacking, how they will, you see, proceed. Now we come on the next slide, you see. Now scope of accounting, data creation and collection, you see. Then we evaluate the data. Then you see, we do interpretive work, and you see data is also reported, also data reporting is also done. Now some important accounting terms are organization. It refers to the size of business and the type of activities. You see, it can be a proprietorship firm, it can be a partnership, it can be Hindu undivided family, private limited company, public limited company, it can be a club, association, trust, society. Now, what are the assets? What you owe, what you own, what you own, they are the assets. You see, assets are those resources owned by the organization that helps the company to earn, you see, profit. The economic value of an item that is possessed by the enterprise is referred to as assets. That is plant and machinery, you see, furniture and fittings, land and building, books, computers, motor vehicles, etc. Assets can, you see, can be tangible, which can be seen or touched, and intangible, which cannot be, you see, seen, like goodwill, patent. Suppose you see some businessman, his grandfather had a, you see, shop, and very famous shop. Everybody in the locality, you see, knows that if you want to say kirana shop, there is a famous shop, and everybody buys the goods from him. So this uh, grandson, you see, who is at present running the shop, so that goodwill is there. You see, he has not to do much for the sales. You see, customers come of their own because of the goodwill of the shop. So this is all about assets, what you are owning. So our assets are what we are owning. Cash, you see, cash is there, furniture fixture is there, plant and machinery is there, computers are there, land and building, you see, are there. And then we motor vehicles, they are also our assets. Then next is our, you see, intangible, you see, assets, that is goodwill and, you see, patent, etc. Now next is, you see, liability, what we have to give to others, you see, that is our liabilities. The economic value of an obligation or debt that is payable by the enterprise to other establishment or individual is referred to as liability. You see, creditors, suppose you buy goods on credit, so that is your liability, current liability you have to pay to the creditors. You see, bank, if suppose you are having bank cash credit limit, that is also your current liability. And then if you are having term loan from the bank for buying any machinery, for buying land and building, you see, land and building, if you have, you see, taken loan from the bank, on the asset side you will show land and building, value of land building, and on the liability side, loan amount you will be showing. So that is your term liability. You have to repay it in many years. Liabilities can be classified as fixed and current. Current liability, which you have to make the payments immediately within 1 year, and fixed liabilities, which you have to pay for in some years. For example, outstanding expenses. This is your current liability. Debentures, loans from banks and financial institutions. They are all your liabilities. Now next is owner's equity, that is capital of the owner, or whatever he has employed in the business, that is his equity. Owner's equity is one of the three vital segments of a sole proprietorship balance sheet. If suppose it is a sole proprietor's balance sheet, and one of them aspects of we are having a accounting equation, that is assets is equal to liabilities plus owners capital, you can say owner's equity. It represents the owner's investment capital in the trade minus the owner's withdrawal from the trade drawings plus the net income since the business concern commenced. Now, steps in accounting cycle are identifying financial transactions and events, measuring of the transactions, recording of the transactions, classifying the transactions, uh, summarizing the transactions, analyzing and interpreting financial data. Now, communicating the financial data or reports to the users. So these are all steps one by one in the accounting cycle. Then bookkeeping versus accounting. Bookkeeping, it is a component of accounting that involves the process of identifying the financial transactions. You have to identify the transaction, measuring the transaction, recording the transaction, classifying those transactions that have occurred in the course of business. Somebody has deposited cash, you have sold the goods, cash sales, credit sales, you have purchased goods, credit purchases, cash purchases. Now, accounting begins where bookkeeping ends. It is a wider concept and includes summarizing, interpreting, and communicating the financial data to the users of financial statements. Now, accountancy refers to systematic knowledge of the accounting principles and the techniques. First point is scope. Bookkeeping involves identifying, measuring, recording, and classifying financial transactions in the ledger accounts. Now, accounting involves summarizing, interpreting, and communicating the financial data to the users of financial statements. Next is objective: to maintain systematic records of financial transactions, to determine the profitability and financial position of the business, that is accounting. Next is stage. It is a primary stage of accounting, is first step, and accounting starts where bookkeeping ends. The nature of the job, it is routine and repetitive in nature, and accounting, it is analytical in nature. Next is level of skills. Bookkeeping does not require special skills and is performed by junior staff. Entries, making entries, generalizing the transactions, posting them into the ledger. And accounting requires specialized skill and is performed by senior staff. Then now next is double entry system and single entry system. The double entry system is based on the dual aspect of principles. For example, cash is a cash sale has taken place. So you have received, the shopkeeper has received the cash account debited to sales. Cash account debited to sales will pass the journal entry. Under this system, both aspects are not recorded for all the transactions. In single entry, single entry is made, both the aspects are not recorded. Then double entry system, every transaction has two aspects, a debit and a credit of an equal amount. You see, in double entry system, every transaction has two aspects, a debit and a credit of an equal amount. This system of accounting, you see, recognizes and records both aspects of the transaction. In double entry system, you see, both aspects of transactions are recorded. Minimum two accounts are involved. You see, minimum two accounts are involved. The accounting equation should not be violated. You see. And in single entry, you see, under this system, both aspects are not recorded for all the transactions. Either only one aspect is recorded or both the aspects are not recorded for all the transactions. Now we come on the next. That is, you see, what are the advantages of, you see, double entry system? It is a scientific system. A complete record of the transaction, you see, then determination of profit and loss, and you see, depiction of, you see, financial position, helpful in, you see, decision making. Top management, they have to, you see, make decisions. So by seeing the financial statements, they decide, they compare the sales of past 3 years, then they then they, you see, predict that in the next, you see, year, coming year, we are going to touch, our sales are going to touch this much. So which, if there is any improvement to be done in any product, that also, you see, is done. If any particular, if any product sales is not there, this means demand is not there. So they may accordingly, they may take the decision. Now, applications of accounting, you see, provide information about financial performance, how the company has done compared to the last year. You see, how is the performance, whether sales increased, or if they did not increase, what is the reason? Say, for example, you see, few years back, COVID was there. You see, at that time, most of the businesses, you see, sales reduced. Then there are other, you see, things also which they come to know from the statements, profit. Then provide assistance to management. You see, top management, owners, you see, they get so much information. And then facilitates comparative study. Yes, you see, you can find out the various, you see, ratio analysis from the balance sheet. You can do for past 3 years ratio analysis, future projected balance sheet also. In that, one can do, you see, ratio analysis. Then helps in settlement of tax liability. Yes, how much is the tax, how they are going to pay. Then it is helpful in raising loan. You see, most of the banks, how they give the loans, it depends on the sale. You see, this cash credit limit, you see, bank is giving 20% of the sales. Suppose some businessman, he had 1 crore sale last year, so bank can give him, you see, 20 lakhs cash credit limit for doing the business. You see, then helpful in decision making. Yes, you see, substitute of human memory. You see, you can't remember everything, but in statements everything is there. Helps in the valuation of the business. Yes, you see, what is the value of the business? You see, that also we can find out. Now, what are the limitations? You see, what are the limitations? You see, Accounting is not precise, you see. Accounting is often subjected to, you see, personal bias or judgment. Accounting is done on, you see, historic values of assets. Accounting records assets at their historical cost, less depreciation, and does not reflect, you see, their current market value. So, what do we mean by this? Suppose you purchase a machinery in 1 lakh rupees and 10% is the depreciation. So every year you will, you see, depreciate it by 10,000 rupees. And first year it is 1 lakh. If we are following straight line method of depreciation, it will become 90, 80, 70. One day the value of the machinery will become, you see, zero. But at that time, machine will have some, you see, value. So what they say here is that it does not reflect the current market value. Then ignore the effect of price level changes. Accounting statements are prepared at historical cost, you see, and thus ignores the changes in the value of, you see, money. For example, you see, we saw that example of that machinery which we are depreciating, you see, 10,000 rupees every month. But after 10 years, the price of the machinery will also be, you see, it may become double. So it ignores the effect of price level, you see, changes. Next is ignore the qualitative information. Accounting ignores the qualitative, you see, aspects as it records only money transactions. You see, qualitative aspect it ignores. Next is affected by window dressing. You see, now what do we mean by window dressing? In a bank branch, you see, if we say to a customer that you have not utilized your full cash credit limit, you withdraw the full limit, and that amount which you will be withdrawing, you put it in your savings bank account. So by this, banks, you see, assets, that is cash credit account, that is increased, and banks liability, that money has come in his savings bank account, that is also, you see, increased. So deposits are increasing, loans are increasing. This is what is window dressing. So window dressing means manipulation in accounting to present a more favorable position of the business than the actual position. So actual position was, you see, different, but some manipulation, you see, has been done. That is what is window dressing. Now, next is reliability. Reliability means that the information must be free from material error and personal bias. You see, unless the information is reliable, the accounting records, you see, cannot be prepared accurate. Next is, you see, relevance. To be useful, accounting information must be relevant to the decision making requirements, see, of the users. Then understandability. Information should be disclosed in financial statements in such a manner that these are easily, you see, understandable. The next is comparability, both intra-firm and inter-firm comparison. Intra-firm and inter-firm comparison must be, you see, possible over different time periods. That is, the performance of company can be compared with its, you see, previous performance and with other companies also. You see how other companies are doing. So other companies also sale is reduced this particular year. So in this, that is in our company also sale is reduced. And you see, last year our performance was this, our sales was this year our sales is this. You see that sales trend also we can compare how much, you see, the sale is reduced. So intra-firm and inter-firm comparison, you see, can be done. Next is, you see, what are the accounting concepts? You see, accounting concepts are the basic rules assumptions and conditions that define the parameters and constraints within which the accounting operates. In other words, accounting concepts are the generally accepted accounting principles which form the fundamental basis of preparation of universal form of financial statements consistently. Now these are all accounting concept entity concept, money measurement, periodicity, accrual, matching, going concern, cost, relation, dual aspect, conservatism, consistency, materiality. Now, first is entity concept. In accounting, a distinction is there between business and the owner. All the records are kept from the viewpoint of the business instead of the owner's point of view. An enterprise is an economic unit separate and apart from the owner. Transactions of the business and those of the owner are accounted for and reported separately. The distinction can easily be maintained in the case of a limited company as it has a legal entity of its own. Now, whenever we form a private limited company, in that private limited company, two people, two directors, two owners, they have to contribute 1 lakh rupees and then they have to apply to registrar of companies. First of all, they will have to select a name, which name they want to keep, and if that name is vacant, the registrar of companies will give them permission that yes, go ahead, you can have this name. Then they will prepare memorandum, then articles, and they will submit all the papers to ROC. Registrar of companies will allow them, and it will issue a certificate of commencement. Then with that, the directors can go for the PAN number of the company, and then with the PAN number and with the commencement of company with the ROC certificate, they can open a bank account. Then whatever amount they are investing, say minimum 1 lakh, they can deposit in the bank and start doing the business. That is how a company, private limited company is formed. Similarly, public limited company. Public limited company, first of all, they have to collect money from the public. They have to sell their shares, in the primary market. And those who applies for the shares, they have to, fill the application. Along with that, they will have to enclose a check. And when the public limited company collects the money, then ROC will give them permission. First of all, they will have to again ask for the name, that name is vacant or not. Then after they have received the money, capital, they can ROC will give them permission. So here there are so many owners. Public limited company, so many owners. Whosoever purchases the share, whosoever has applied for the share and he has allotted and he has paid, application money, allotment money, first call money, second call money. All this, the money if he has paid, and if the public has been allotted shares, allotment has been done, then they all are the owners of the company. Similarly, private limited company, minimum 2 people. So here what they are trying to say is the distinction can easily be maintained in the case of a limited company as it has a legal entity of its own. Company has a legal entity of its own. Like human beings, it can engage itself in economic activities of producing, owning, managing, storing, transferring, lending, borrowing, and consuming commodities and services. However, it is difficult in case of partnership and in case of one man business proprietorship. For accounting still maintains separation of owner and the business. This means the personal and household expenses of the owner will appear in the books of account. It's just for accounting purpose that partnerships and sole proprietorship are treated as separate and apart from the owners, though the law does not make such a distinction. Justifying the creditor will involve both the business assets and personal property. The next is money measurement concepts. As per this uh, postulate, accounting records only those transactions which can be expressed in terms of monetary terms. You see, that is money measurement. As a result, those transactions which cannot be expressed in terms of money are not recorded in the books of account, though they may be very useful for the business. For instance, if a business has got a team of dedicated and trusted employees, it is definitely an asset to the business because they will do their best. They will, you see, the company, the business will progress, the business will earn profits. It is definitely an asset to the business, but as they cannot be measured in terms of money, they are not recorded in the books of business. Similarly, goodwill is an intangible asset and cannot be recorded in the balance sheet as an asset until it is valued in terms of money. Few terms that cannot be expressed in monetary terms, like general health conditions of the chairman of the company, working conditions, sales policy, quality of products, labor management relations, etc., are not recorded in the books of accounts. Also, the money measurement postulate, you see, assumes that the rupee or dollar or pound sterling is stable and standard measuring unit. Hence, transactions are reflected in the accounts in terms of the monetary unit at the time of transactions. There is continued use of the same money of account even if there are, you see, changes in the purchasing power of money during the intervening, you see, period. There are two major limitations of money measurement postulate. It restricts the scope of accounting because it records transactions which can be expressed in terms of money, and the transactions that cannot be expressed in terms of money are not recorded. It does not keep in concern the effects of inflation because it assumes a stability of the money measuring, you see, unit. Now we come on the next. Next is, you see, we take cost concept. The resources, you see, like land, buildings, machinery, property, rights, etc., owned by a business are called assets. The money value which is assigned to these assets is derived from the cost concept. According to this concept, an asset is worth the price paid for or cost incurred to buy it. Assets are recorded at their original purchase price, and this cost is the basis for all subsequent, you see, accounting for the assets. It is not necessary that the assets recorded in the financial statements indicate their market worth. The book value is a term which is used for the amount shown in the accounting records. Next is, you see, accrual concept. Accrual concept is, you see, associated with matching concept. Accrual concept states that revenues and costs are, you see, accrued. That is, revenues and costs are recognized as they are, you see, earned or incurred and recorded in the financial statements of the period to which they relate. To identify appropriate profit or loss for a period, income and expenses accrued but not received and not paid must be taken into consideration. All incomes raise the capital and losses decrease the capital, but every increase in capital does not always mean incomes, and every decrease in capital does not always, you see, mean losses. Addition to the capital by the proprietor may result in increase in capital. Revenues and expenses do not depend upon the time periods when cash is actually received or incurred. An increase in cash does not necessarily mean that the position of the owner has improved. The increase in cash may merely be offset by decrease in some other asset or increase in a liability. Next is the concept of, you see, conservation. The concept of conservation is also called the concept of prudence, is often stated as an anticipate no, you see, profit, provide for all the business losses. This states that an accountant should follow a cautious, you see, approach. He should record the lowest possible value for assets and revenues and the highest, you see, possible value for liabilities and expenses. According to this concept, revenue or gains should be recognized only when they are realized in the form of cash or assets. The ultimate cash realization, which can be assessed with reasonable certainty. Also, a provision must be made for all known liabilities, expenses, and losses, whether the amount of these is known with certainty or a situation. The ultimate outcome is gain or loss, which cannot be identified accurately at present. It will be identified only after the event has occurred. As a result, net assets and incomes are more likely to be understated than overstated. The widely used practice of valuing inventory at cost or market price, whatever is lower, is based on this concept. These days, this convention has been, under stress. It has been challenged by many writers on the ground that it gives unfair determination of profit and disclosure of the true and fair financial position of the business enterprise. Next is, materiality concept. Various events in the business are, trivial or insignificant in nature. The cost of recording and reporting such events will not be justified by the usefulness of the information derived. The materiality concept states that items which have small significance need not be given strict, theoretically correct treatment. For example, a scissor costing rupees 30 may last for 3 years. However, the effort involved in allocating its cost over the 3 years is not worth the benefit that can be derived from the given operation. The item is immaterial when related to overall operations, and so the cost incurred on it may be treated as the expense of the period in which it has been acquired. The accountant would consider the stock lying unused as immaterial. Hence, the entire amount spent on unused stock would be taken as the expense of the period in which such expense was incurred. Where to draw the line between material and immaterial events is a matter of judgment and common sense. No hard and fast rules, lies there. Next is consistency concept. There are several ways to record an event or a transaction in the books of accounts. For example, the trade discount of raw material purchased can be subtracted from the cost of goods and net amount entered in the books. Or alternative can be trade discount can be shown as a income with full cost of raw material purchase entered in the books. Similarly, there are several methods to change depreciation of an asset or of valuing inventory. The consistency concept states that once a company has decided on one method, it should continue to follow the same method for all subsequent events of the same character unless it has a valid reason to use another method. If for valid reasons the company decides to use another method, then the effect of the change must be clearly stated in the financial statements in the year of change. Much of the utility accounting information lies in the fact that one could draw valid conclusions from the comparison of data drawn from financial statements from one year to another year. Comparatively is necessary so that trends or difference may be identified and evaluated. The reported profit of income and assets can be affected by inconsistency in the application of accounting methods. The comparability of financial information largely depends on the consistency with which given classes of events are handled in accounting records year after year. Next is, periodicity concepts. The measurement of income of a business entity can be accurately made only when it has a definite time limit. However, the going concern postulate assumes the continuity of business for many years. The owners, investors, government, etc., are impatient, and unwilling to wait till the business is liquidated. They maintain and require, regular reports and accounts at proper intervals to know how things are, going. This means that the financial statements must be prepared on a periodic basis instead of waiting, until the business is terminated. Accountants follow periodic postulate to facilitate the preparation of financial statements on a periodic basis. This postulate states that the life of the business is divided into appropriate segments with the purpose of studying the results shown by the business after each segment. The segment of time interval is known as accounting period, which is usually of a year. According to Yoston, Smith, and Brown, an accounting period is an interval of time at the end of which the income or revenue statement and balance sheets are prepared in order to show the result of operations and change in resources. The principle of segregating capital expenditure from revenue expenditure is based on this postulate. It also plays a very important role in identifying the income of a particular accounting period and in ascertaining the financial position of a business entity on a particular date. Next is going concern, postulate. The going concern postulate of accounting does not presuppose its liquidation and view business as a going concern entity. The postulate is also known as continuity postulate. According to this postulate, unless and until the entity has entered into a state of liquidation, it is to be viewed as having an indefinite life. Directors will keep on coming and going, but company will go on. Transactions are recorded in the books, keeping in view that the business has the indefinite life. The going concern postulate has, the suppliers supply goods and services, and other business firms enter into business transactions with the business unit as per this postulate. If suppliers feel that the concern will be liquidated, they will not supply goods and services, and other persons will not have business dealings with the business entity. Long-term assets are valued at cost excluding depreciation. The value of assets is neglected due to the fact that the business is a going concern and it shall not be forced to sell its fixed assets. If we don't keep this postulate in concern, the fixed assets would have been valued at an amount which they would have fetched in a second-hand market. Inventories are valued at cost or market price, whichever is lower. If the business is not considered going concern postulate, they would have been valued at a price which they would have fetched in the event of forced sale. Hence, it implies that business of this postulate inventories are valued at cost. Due to going concern postulate, prepaid expenses are recorded as assets in the balance sheet. It is hoped that the entity shall reap the benefit of a prepaid expense. If the business is not considered going concern, prepaid expenses would be written off, as the company shall neither be able to take the benefit of expenses paid nor be able to recover money from the various parties. The postulate also lays emphasis on the determination of net income rather than on the valuation of assets. The accountant directs his attention to the proper allocation of expenses and incomes to the current period. He is not concerned about the market value of fixed assets. Matching concept is based on periodic postulate. The primary goal of a business is to earn profit. For this purpose, major share of attention of the accountant is absorbed in the evolving technique for measuring profits. To measure the profits made by the business during an accounting period, it is important that the revenues of the period should be matched with the costs incurred during the period. The term matching, means association of related revenues and expenses, that is comparison of the revenues earned with the expenses incurred for earning the revenue. Hence, the matching concept states the matching of expenses against related revenues. The matching of cost with revenue appears to sample one while studying theory, but practically this concept exerts certain problems which require, expert judgment of the accountant. Matching concept involves two questions. What criteria should be used as a basis for associating cost with, present and future periods? How shall the expiration of product and service factors be measured? You see, the first step in the application of the concept is to determine the period in which revenue is to be, realized. There are certain bases used for determining the period in which the revenue is realized are sales, basis, cash basis, and the production basis. The second step involves finding out the cost and expenses to be matched with the revenues. Various, adjustments are required to be made for outstanding expenses, accrued incomes, prepaid expenses, unearned incomes, etc. Suppose you have, uh, paid, say, some expense, electricity bill, you have paid for the next quarter also. So for that quarter, from while finding out the profit, we will reduce that much, bill. Now, matching concepts, also requires the application of personal judgment in making the estimates of for doubtful debts, discounts, etc. Besides these practical difficulties preparing financial statements, the matching concept should be, followed to have a true and fair view of the profitability and financial position of a business, entity. Next is relation concept. Relation concept is based on recognition of revenues. This concept states that the revenue is considered as being earned on the date at which it is realized, which is on the date when the property in goods passes to the buyer and he becomes legally liable to pay. Next we come is, very important, dual aspect concept. Okay, the relation concept, Anupam places an order, for example, with Neeraj for supply of certain goods yet to be manufactured. On receipt of the order, Neeraj purchases raw materials, employs workers, produces the goods and delivers them to Anupam. Anupam makes payment on receipt of goods. In this case, the revenue will be presumed to have been realized not at the time of the order for the goods, but at the time when goods are, delivered to Anupam. Anupam will pay only when he will receive the goods. He will not, he may give advance also, Supplier can demand some advance also from the purchaser. No profit can be, earned without the sale of goods and services. However, there are certain exceptions to this concept in case of hire purchase. The ownership of the goods sold passes to the buyer only when last installment is paid. But sales are, presumed to have been made to the extent of installments received and installments due, but not received. Next is our dual aspect concept. This is the basic concept of accounting. As per this concept, every business transaction involves twofold aspects, and both the aspects have to be, recorded in the books of account. For example, if you have made a sale, suppose if you have made a sale of, goods, the business will get either check, check or cash. So your cash account, bank account will be, debited to sales. So this was, our last accounting concept. Now we go to the next slide. Here they have again explained, entity concept. Entity concept is a concept which explains to you that your business is different than you. Business is different and you're different. It tells you that the business owner and the owner are two separate, entities. The statute recognizes the entity as an artificial person. The entity is required to prepare its own set of, financial statements and record its business transactions, accordingly. And your personal, statements are different. You have employed capital, you have employed money in the business. For example, Mr. and Messrs. Tata and Sons, when owner gives money to business, it is, termed as capital, and the business has to return this money to the owner, so it becomes a liability for the business. That is why it is written on the liability side of the balance sheet. You see capital, then other liabilities are there. And then on the right hand side, assets are there. Next is money measurement concept. Money measurement concept states that only those transactions are recorded and measured in monetary terms. In simple words, only financial transactions are recorded in the books of accounts. Emotional aspect does not, you see, come in the accounting. Next is periodicity concept. Periodicity concept states that the entity or business needs to carry out the accounting for a, you see, definite period, usually the financial year. The period for drawing of financial statements can be vary from monthly to quarterly to annually. It helps in identifying any changes occurring over different periods. You see, normally big companies, they make, you see, every quarter their balance sheet, profit and loss account balance sheet. And you see, small concerns, they make it for the year, you see, right from 1st April to 31st March of the next year. Then accrual concept, the transaction is recorded on a, you see, mercantile basis of accounting, wherein the transactions are recognized and recorded as and when they take place. You see, in other words, transactions are to be recorded as and when they occur, not as and when the cash is received or paid, and for the period to which the transaction, you see, pertains. Next is matching concept. The matching concept states that the period for which revenue has been considered, the entity needs to account for expenses only relating to that period. It means that the entity has to record revenue and expenses for the same, you see, period. Suppose you have paid rent in advance, so for that particular period, the rent, you have to minus that portion of rent which has been paid, you see, in advance. Suppose you have received some interest, but interest has not been paid, so whatever is the amount of interest, you have to add, you see, in your profit. You see, going concern concept is an assumption that the business will be carried on ongoing basis. Thus, the books of accounts for the entity are prepared such that the business will be, you see, carried on for years to come. You see, your business, like a private limited company, public limited company goes on. You see, directors will come and go. Cost concept, you see, states that any asset that the entity records shall be recorded at historical cost value, that is the acquisition cost of the asset. If you buy machinery for, say, 5 lakhs, so is the cost is 5 lakhs, and other expenses incurred in procuring the machinery. You have to add transportation cost, insurance cost, labor cost for installation. Then your final cost of machinery will be there. Next is relation concept. This concept is related to the cost concept. The relation concept states that the entity should be, you see, should record an asset at cost until and unless the realizable value of the asset has been, you see, realized. Practically, it will be correct to say that entity will record the realized value of the asset once the asset has been sold or disposed of, as the case may be. Then they will see, you see, what is the, after reducing the depreciation, then they will see whether they have made profit or loss by selling that, you see, asset. Dual aspect concept. This concept is the backbone of double entry bookkeeping system. It states that every transaction has 2 aspects, debit and credit. Suppose you have deposited cash in your account in the bank, you see, banks, that particular branch cash account will be debited and your account will be credited. You see, now there is computerization, immediately it is done in no time. So there are 2 aspects. The general entry will be bank's cash account debited to your saving bank account. The entity has to record every transaction and give effect to both the elements of debit and credit. For example, if you buy a machinery, so your machinery account is debited, and if you are paid by check, so your bank account will be credited. So asset value goes up you bought by paying cash or check. So asset value, your cash, you see, and bank account balance will go down. So it is having dual effect. Both will be on the asset sides of the balance sheet. You will have machinery, and your bank balance will, you see, reduce to that extent. Next is conservatism. This conservatism concept states that the entity needs to prepare and maintain its book of accounts on a prudential basis. Conservatism says that the entity has to provide for any expected losses or expenses. However, it does not recognize future revenue, you see, expected. Next is consistency. The accounting policies are followed consistently to achieve the intention of comparing the financial statements of various periods, or for that matter of multiple, you see, entities. If you apply for credit facilities to a bank also, you'll have to submit your 3 years, if you're if 3 years audited balance sheets, your, you see, projected balance sheet of the next year. Then bank will, you see, do exercise, and then bank will sanction you credit facilities. Next is materiality. The materiality concept explains that the financial statement should show all the items having a significant economic effect on the business. It allows ignoring the other concepts if the item to be disclosed is having an insignificant impact on the business of the entity, and the efforts involved in recording the same is, you see, not worthwhile. So this was, you see, we are closing the session now. Students, thank you very much.